talking about Forex mathematics. We started with Forex mathematics, and then some of the things that we were going through were looking at how much to deposit. We're looking at balance. We're looking at equity, free margin, margin level, margin, points, pips, pipettes, point value, pip value. And then we are going to look at how to calculate for profit today. And then we will start doing some examples on how you profit by going long or going short. Okay, so we said that with the symbol properties and then contract specification, we said that brokers are not the same. They differ in the parameters they set for any trading asset on their platform. The symbol specification window features the symbol trading conditions. That is your contract specification. And the parameters set for the asset are the properties or the contract specification of that particular asset. So the parameters they set give you all the information you need for any calculation on the asset. So we said that always check for the contract specification, check the symbol properties of an asset to have the accurate parameters for your calculation. You don't just do any calculation. You have to try as much as possible to access all the necessary information from the contract specification window. And then we went through how we can access the contract specifications or the symbol properties of every asset we have on the platform. And I gave an example that, for instance, if you want to look at the contract specifications or the symbol properties of GBP USD, what you need to do is that with the MT4, what you need to do is that you just tap on the asset, you see symbol properties, you tap on the symbol properties, and then the properties of that particular symbol will be displayed over there. And in that window, you see your spread, the type of spread we have over there. You see your targets, you see stop levels, you see contract size, and many other things that are necessary for any calculation you want to do. And then with the MT5 to the same process you go through, but with the MT5 there are other things that are added to the symbol properties of the contract specification window. And then we went to the desktop version of the contract specification, how you can access it. We said that when you go to your market watch, you select and then right click on the asset, and then a pop-up window will come. You see specifications over there. You click on the specification, it will take you to the contract specification window. At that particular point, you see all the details that you need, all the parameters that you need for any calculation. And we did the same for the desktop version of the MT5. The same thing. This is the Gildas, our platform, and we went through how to access all the informations from the contract specification. And then I answered all the questions that you asked me yesterday. And we went straight into contract size, volume, and lot sizes, okay? So we said that contract size is the standardized amount that tells buyers and sellers exact quantities that are being bought or sold based on the terms of the contract. Then we said you have to note that there are different contract sizes of assets in other markets or sectors of the Forex industry. You can find out from the asset or the symbol specification window. So we went through that, and then you saw, we realized that we have different values for contract sizes from different brokers, okay? And we said that the contract size is always the standard volume in units or one lot in size of that particular asset. So when you go to your contract specification and then you see your contract size, that contract size is your standard volume or your standard lot in unit or your standard lot in size of that particular asset. And then we said that when we say lot, what is lot? And we say lot is the number used to represent the unit, quantities or volumes of the financial asset, okay? So if the standard volume for one lot in the currency market was 100,000 units, in this sense, it means that the volume was 100,000 units, but when you quantify it in lot, it is one lot. And we said in the past, the standard volume for one lot in the currency market was 100,000 units. However, to open up the Forex industry to a wider range of participants, including the retail traders like you and I, there are also the mini, the micro volumes that are 10,000 units for the mini, 1,000 units for the micro, and in their lot sizes, we have them as 0.1 for the mini, 0.00, 0.01 for micro, okay? And I showed you this table that explains or that lists the various volumes that we have. So we have the standard volume in units, it is 100,000, and then in lot size, it is 1. And then we have the mini volume in units, it is 10,000, and then in lot size, it is 0.1. And then the last one, we have the micro, which is 1,000, and then in lot size, it is 0.01. So these are the three basic volumes or three basic lot sizes that we have. And I explained to you that there are other lot sizes like the nano lot size, which is 100 units, and then 0.001. But with this, with the nano lot size, we see that most often with different sectors of the Forex industry. And I made a typical example to trading VIX 75 and all the other assets that we have on the financial market. Okay, and we came to this slide, and I said that when you are buying, okay, or when you are selling, in actual sense, you are selling in units or you are buying in units. So, for instance, if I buy Euro USD, if I buy one standard lot of Euro USD, I am actually buying 100,000 units of the euros. If I am buying one mini lot of the Euro USD, I am actually buying 10,000 euros of the Euro USD. If I'm buying one micro lot, in actual sense, I am buying 1,000 euros, okay? And the same thing applies to all the others that we are having over here. Administrators, please work for me. Bills, you are welcome. Please mute yourself for me. Okay, so let's continue. And then I answered all your questions pertaining to that, and then we came to leverage, notional value, and deposits, okay? So what did we say leverage was, or leverage is? We said leverage is a borrowed fund to you from your broker in order to scale up your small investment capital for potential returns, okay? The amount borrowed is a notional value, which is used in calculations, but not an amount added to your capital. So I told you that leverage simply means borrowed money from your broker to you, and the purpose for leverage is to scale up your small investment capital for potential returns, okay? And we said that leverage enables you to control or buy or sell bigger units of currencies with relatively small capital or deposits. And we also said that leverage is expressed in ratios. Okay, so for instance, a leverage of 1:500 means that the trader can trade the volume of as much as 500 times his or her invested capital. So for example, a forex broker may offer 1:50 leverage. It means that with a deposit of $50 margin, with a deposit of $50, you'll be able to trade, or you'll be able to buy or sell up to the tune of 2,500 worth of currencies. Okay, and similarly, if you have $500, when you are given a leverage of 1:50, you can trade with $25,000 and so on. And these $25,000 that I mentioned, or the 2,500 that I mentioned, as I said, it's a notional value. It is not added to your deposit, so it's not added to your invested capital. And then we came to this table. So leverage and notional value. So we said that assuming you are having $200, how much notional value you can control with a given leverage. So when we did that, we said that, for instance, if I am giving 1:2 as leverage, my notional value or the control that I'm going to have is going to be 400. And then when I am trading, I'm not going to be able to trade because the system will tell me that I have insufficient. Why do I have insufficient balance? I am having insufficient balance because the $400, which is the notional value, is not up to the tune of either a standard lot, mini lot, or a micro lot, okay? And when I'm giving 1:10, for instance, my $200, I'll be able to control 2,000. And with that 2,000 notional value, I'll be able to trade 0.02 lot size. That is 2 micro lots. And then when I'm giving 1:50, that is going to be 10,000 notional value. That is the controlling power. And I'll be able to trade one mini lot. Okay. And then if I'm giving 1:100, it is going to be 20,000. And that would be 2 mini lots, which is 0.2. And if I'm giving 40, when I'm giving 200 as leverage, 1 is to 200 as leverage, I'm going to be able to control 40,000, and that will be 4 mini lots, which is 0.4. And when I'm giving 1 is to 500, with my $200, I'm going to be able to control 100,000, which is just 1 standard lot. Okay, so that is leverage and then notional value. And we came to this slide, and then we said that assuming you want to also trade 1 standard lot, how much are you supposed to deposit? Okay, so let's say you want to trade a standard lot, and we said that 1 lot size or a contract size of 100,000 is the standard lot. So how much do I need to deposit to be able to trade this particular 100,000 units of currency? And we said that if you are going by leverage, let's say if you have been given 1:1, it means that you are going to deposit all the 100,000. That is the deposit required of you to be able to trade a contract size of 100,000. And then when we are given 1:50, we are supposed to deposit $2,000. That will be the deposit required of you to be able to trade 1 standard lot or a contract size of 100,000. And then if you are able to, if you are giving 1:100, your deposit required is going to be 1,000 to be able to trade a contract size of 100,000. If you are giving 1:200, you are going to be required of $500 deposit to be able to trade a contract size of 100,000 units. And then if you are giving 1:1,000, okay, 1:1,000, it means that the deposit that is required of you is just $100. And with $100, you are going to be able to trade a contract size of $1,000. Now, with this said, you can see that when you are being given leverage, okay, when you are being given leverage, leverage helps you to control a higher value or be able to trade a higher value even if your deposit is very small. And I said that leverage is a two-edged sword. It has positive side and then it has the negative side. But the positive side is that you are only required to deposit just a smaller amount to be able to control a bigger amount, okay? And then, as I said, I don't want to emphasize on the negative side of leverage. However, we always peg ourselves to choosing reasonable leverage. That is from 1:100 up to 1:500. That is a reasonable leverage that I always want my people to have. Now, I want to also add that if you have a sizable deposit, for instance, if you're having, let's say, $10,000, okay, and you want to trade with that $10,000, you don't need to take a higher leverage. You have to go for, let's say, 1:100, okay? If you're having, let's say, $5,000 that you want to trade with, you don't need to go for 1:500, 1:600, 1:800, 1:1000. You can stay within 1:100 and then 1:200. Now, I want to emphasize that the only time you go a step higher, okay, let's say 1:400, 1:500, is when your deposit is less than, let's say, $1,000 or less than, let's say, $5,000. But if your deposit is more than $5,000, I expect that you don't go above 400 leverage, okay? However, since our deposit, the least deposit that we expect of our student is $200, we always want our student to choose or stick to 1:500. Okay. Let's continue. And then I answered all your questions. And then we moved on to margin calculations. Okay. So we said, as we stated, as was stated, that leverage is a borrowed notional value. Margin is a collateral to assess that loan. Okay, so the leverage is our loan, and when you are going for a loan, you don't just pack your things and go for the loan. You have to deposit something down. You have to put something down. Sometimes it's even your house, a land, or a document that is worth the amount that you are going for. So if your broker is giving you a loan, then what the broker will put down or what the broker expects you to put down is your margin. Okay. And this margin is not a trading or transaction cost. It is just an amount you set aside as a good faith deposit, as you do with our normal life when you are taking a loan from an institution, a financial institution. So what is margin? Margin is the amount of money required to open a trade and to keep that trade running. That is the definition that you have to keep in your mind. Margin is the amount of money required to open a trade and to keep that trade running. So the moment you click on either buy or sell, or you put an order in the market, what is going to happen is that your broker is going to keep an amount from your deposit, and that amount they have kept is the amount that is deemed as margin. And this particular amount is the amount that is going to enable you, okay, it is going to enable your trade run, it is going to enable you open the trade, and it's also going to enable your trade to run. So without margin, you cannot open a position. And we said that margin is calculated based on your leverage. Okay. And then we came to the ways we calculate for margin. Okay. The first one, we said that you can calculate margin by using margin required as a percentage of position size. And yesterday, I really loved the participation. It was awesome. When we went into the position size, everybody was giving what they have learned. We were quoting the formulas verbatim, and I was so excited about that. And the second aspect of it is that sometimes, as we learned from the contract specification, the broker will now specify how your margin needs to be calculated, or the method you will need to apply when you want to calculate for your margin. So we said that there is a method for calculating margin, and that method is the method for Forex. We also have a formula for calculating margin when it is stated that use Forex no leverage method, okay? And then we also have the contract or exchange stock. We have CFD, that is contract for difference leverage, okay? It means that we can also have CFD with no leverage. It means that that particular calculation, you are not going to apply leverage. We have the CFD index, we have the CFD, and then margin percentage, and we came to fixed margin, okay? All right. Now, I answered your questions, and then we went down to margin required as a percentage of position size, okay? So we said that margin required is the percentage based on leverage. And I said that, for instance, if you are being given leverage of 1:10, your margin required as a percentage is 10%. How did we get a 10%? We said that margin required is equal to 1 over your leverage times 100, okay? Or it is your leverage ratio times 100. You can put it short that margin required is equal to 1 over leverage, or margin required is your leverage ratio times 100. Why are we saying 1 over leverage? You know that all the leverage we have over there, it is either 1:1 a number, 1:1 a number, 1:1 a number. Okay. So in percentage wise, if you want to express your leverage in a percentage, for you to be able to calculate for your margin, for instance, 1:10 is 10%. That is 1 over 10 times 100. When you do the calculation, you are going to get 10%. And this 10% in decimals is 0.1. And then if you are being given a leverage of 1:2, that is 5%. In decimals, 0.05. Okay. The same thing applies to when you are being given a leverage of 1:500, and that one is going to be 1 over 500 times 100, and when you do the calculation very well, you are going to get 0.2%, and that 0.2% in decimals is 0.002. Okay, so what does it mean? It means that for 1:10 leverage, your broker will keep 10% or 0.1 of your position size. Listen, not your account, not your balance, okay, not your equity, but rather a percentage of your position size. So for 1:10 leverage, your broker is going to keep 10% or 0.1 of your position size as your margin to keep your trades open and then your trades running. So for 1:100, your broker is going to keep 1% or 0.01 of your position size as margin. And we said that margin required is the least deposit to make an order to hold a position size on an asset. Okay, so your margin required is the least deposit to make in order to hold the position size on an asset. You have to also put that in your note. And then we came to position size. We said that this is the actual size of open positions or trades. So anytime you trade, let's say 0.1, 0.2, 1 lot size, any lot size that you trade, okay, when you open the trade, there is what we call the position size. That is the size of the entire trade that you have opened, okay? And the position size takes into account lot size and then your contract size. And this contract size, we explained that you can have the contract size from your contract specification. So we were given a formula, or we arrived at a formula that position size is equal to volume in lot size times contract size, okay? So position size is always in the base currency, as we said. When you do the calculation of position size, your calculation your calculation will be in your base currency. So for instance, if I'm trading, let's say GBP USD, and then I open a position, if I calculate the position size of my trade, that is the GBP USD, the answer I am going to get is going to be in GBP, that is in pounds. And then if it is in pounds and my deposit account or deposit currency is different from that particular currency, let's say the base currency, then there is what we call conversion rate. So at that particular point, a conversion rate is needed. So we said that if the base, that is the margin currency, is different from the deposit currency, a conversion is needed. And we said that this will change the formula a bit. Okay, so we went through the conversion and how we will do the conversion. Okay, and we said that for a US dollar account, this is how you convert from base, that is the margin currency, to account deposit currency. So you use the bid price for sales and ask price for buys. So for a direct rate, that is a pair, okay, a currency paired with the US dollar, you multiply by the OMP, and we said that the OMP simply means open market price. I explained that extensively to you yesterday. So for instance, if I am doing, I'm trading GBP USD, okay, GBP USD has a direct rate. For that matter, the answer, after I have gotten my answer, I have to multiply again by the OMP of GBP USD. So if I am trading Euro USD is having a direct rate. So because Euro USD is having a direct rate, I have to multiply again by the OMP, that is the open market price of the Euro USD. And then we went to indirect rates, okay? With the indirect rate, we are saying that the USD paired with another currency. So if I have the USD as a base currency paired with another currency, then there is no conversion needed. Why is it that when we have indirect rate, we don't add any conversion rate? Simply put, because with the indirect rate, the answer is already going to be in the US dollar. The answer is going to be in the US dollar. We have explained the direct rate, indirect rate, and then the cross rate already. You should revisit them in your notes. Okay, then when we have a cross rate, how do we convert from a cross rate to our deposit currency? So we said that with a cross rate, that is a rate without the USD, okay? So two pairs without the USD, you multiply by the conversion rate below. So for instance, if I am trading Euro as a base paired with any other currency apart from the USD, example, Euro GBP, then I have to multiply by the price of Euro USD, okay, to arrive at my final position size. If I have GBP crosses, that is GBP paired with any other currency, in a GBP being a base currency, then I'm going to multiply by the price of GBP USD. If I have AUD crosses, I'm going to multiply by AUD USD. If I have the CAD, okay, CAD paired with any other currency, what I'm going to do is that I'm going to multiply by the inverse price of the USD CAD. I said that this one you were supposed to multiply by CAD USD, but in our writings there is nothing like CAD USD. Rather have USD CAD. So when you compare USD CAD to CAD USD, you will see that CAD USD is the inverse of USD CAD. So for CAD paired with any other currency, if you want the position size, the end result, you need to multiply by the inverse price of USD CAD. The same applies to CHF. Okay, so we said that if margin currency and profit currency are same, you multiply by open market price of same asset. All right, so we took examples. We are not going to go through the examples. I'll just read through. We are not going to do the calculations again. We did the calculations yesterday. Okay, so having said that, we did these examples, and then example 1, we said, for instance, if I want to sell one lot size of Euro USD at 1.13890, what will my position size be? And we said that from our formula, position size is equal to volume in lot size times contract size. Okay, so from our contract specification, we have our contract size to be 100,000, and then the volume in lot size is how much we are trading. Okay, the lot size we are trading, and the lot size we are trading over here is 1. So position size is now going to be 1 times the 100,000, which is going to give us 100,000 euros. So you see that when we did the calculation, we had 100,000 euros, and Euro USD has a direct rate, so you multiply by the open market price to get your USD, and we had the position size to be 100,000 euros times the open market price, which is 1.13890, and we had 113,890 US dollars. Okay, and we went through this example. This example is USD CHF, and when we did the calculation, we said that USD CHF has an indirect rate, and for that matter, there is no conversion. So our answer, we leave it as 20,000 US dollars. And then we said that without leverage, position size is what you are supposed to deposit to be able to trade the lot size of the currency pair you wish to trade. Okay, position size without leverage is what you need to deposit to be able to trade the lot size of the currency pair you wish to trade. So with leverage, what you need to deposit is the margin, and that is called a marginal deposit. So we went straight into how we can calculate our margin required as a percentage of position size, and we understood that our margin is equal to position size times the margin required, and we said that our margin required is equal to 1 over leverage. So when we did the calculations, okay, the substitutions and all that, we realized that our margin required is going to be position size times 1 over leverage. And when we broke it down, or we brought it down, we had our margin required being equal to position size over leverage. So this is your margin. Your margin is equal to your position size over leverage. I want you to write it in the chat box for me. Margin is equal to position size over leverage. Write it for me. Margin is equal to position size over leverage. I want to see you write. Write it for me. Margin is equal to position size over leverage. Write it. I want to see not less than 5 people write that for me right now. Not less than 5 people. Okay. Thank you, Insia. Thank you, analyst. Thank you, Don Gideon. Thank you. Yeah, I'm left with 2. 2 people should write. Margin is equal to position size over leverage. When you write it, it sticks in your mind. When you write it, it sticks. So write it. Be bold and write it. Julius, thank you. Bismarck. Okay, so let's continue. And then we went through examples. So for instance, if you sell one lot size of Euro USD at this particular price level with a leverage of 1:200, we ask ourselves, what will our margin be? And then we did the calculation. We said that if we are buying one lot size of Euro USD at 1.13890, our margin is going to be our position size times margin required. So our position size is 1, and then the contract size, our contract size, we are taking it from our contract specification. And from our contract specification, our contract size is 100,000. So 100,000, okay? And that 100,000, 1 times the 100,000 becomes our position size, okay? Times our OMP. We added the OMP straightforward. Why did we do that? Because Euro USD is having a direct rate. So we added the OMP straightforward, okay? All right, so when we did that, we had our position size to be $113,890 US, and then the margin required, we said that our margin required is equal to 1 over leverage, okay, or our leverage ratio times 100. So 1 over 200 times 100, then we have it at 0.5%, which in decimals is going to be 0.005. Okay, so when we put all that together, our margin was going to be that 113,890 for our position size times our margin required, which is 0.005, and we have $569.45 US. Okay, and we said that you can do that straightforward by quoting margin is equal to position size over leverage. So you just put your leverage over there, put your position size over there, you divide it by your leverage, and then you have your answer. Now, we concluded by saying with that leverage, you are supposed to deposit $113,890 US to be able to trade one lot size of Euro USD at 1.13890. And I'm telling you, anyone on this call, if you are supposed to pay this or deposit this before you can trade just one lot size of Euro USD at that particular amount, I'm telling you, it is going to be very, 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 very hard for you. I don't think that all of us over here have that amount of money to be able to open just one lot size of Euro USD at 1.13890. However, with leverage, you only need a marginal deposit of $569. So with leverage, all that you need is just $569 to be able to trade one lot size. Okay, so with that leverage, you are supposed to deposit $113,000. But with leverage, you are going to deposit only $569. Okay, in other words, your broker will keep that $569.45 whenever you open a position of one lot on Euro USD at that particular price level. And then we did more examples. Okay, we did more examples. After that, we put our formula together to arrive at one concrete formula we can apply everywhere. Okay, so we said that margin is equal to position size times margin required, and we said that position size is equal to volume in lot times contract size, and the margin required, we said that it is equal to 1 over leverage. For that matter, if we do substitutions over here, we are going to have our margin formula now reduced down to volume in lot times contract size over leverage. Those who joined the call yesterday, we said a lot about this. All right, Godfred, I'm seeing you giving us short hands. Thank you very much. All right, so anytime you are doing calculation for margin, this is your formula. The formula is that margin is equal to volume in lot times contract size all over leverage. I want you to put that in the chat box for me, that margin is equal to volume in lot size times contract size over leverage. You can put that in the chat box for me. I want one person to do that quickly, then we continue from there quickly. I have 4 minutes. I have 4 minutes to finish with a summary. Quickly put that down for me. Someone is saying, please, can we use margin and margin required interchangeably? Very, very well. Yes, you can use that interchangeably. Here, you can use that interchangeably, okay? Okay, so margin is equal to volume in lot times contract size over leverage. Thank you very much, Gideon. Thank you very much for your participation. Now, we said that the answer you have when you do the margin, okay, when you go straight by this, the answer you are going to get is always going to be in the base currency. So if your deposit account is different from your base currency, then a conversion rate is needed. Okay, a conversion rate is needed. So we said that the answer is multiplied by a conversion rate when the base currency is different from the account or the deposit currency. This is an advanced course that we have put into our beginners class. We don't want our students to be left with some knowledge that they need to have before they move into the advanced level. If you get to the advanced level, you are not going to be taught these things again. So we deemed it right that we brought this particular course, the Forex Mathematics, into the beginner's course. So please pay attention. All right. So we had an example, and we said that here our leverage is 1:200. Our contract size is 1,000, and then our volume in lot size, you can see over there, is 0.1. Okay, our open market price is 1.1389, and then we did a calculation. We said that our margin is equal to volume in lots times contract size over leverage. When we did the calculation, we had 50 euros. Okay, 50 euros. However, our account is in dollars. Our account is in dollars. So because our account is in dollars, conversion is necessary. And Euro USD has a direct rate. For that matter, you multiply again by the open market price. Therefore, the margin the margin is equal to 50 times the open market price, which gave us the $56.945. And then when you write it to two decimal places, you are going to have $56.95. Thank you. And then we tried our hands on this. When we tried our hands on this, we had an answer, and we deferred the answer for the next lesson. Okay, so I answered all your questions, and then we went into margin calculations, the calculation method that are stated in the contract specifications. So I told you that the one that we went through is for Forex, okay, when there are no conditions in your contract specification, okay, that is what we use for currencies. However, when you go into your contract specification, sometimes they state how you need to calculate your margin, and we looked at some examples. So these are some of the examples. They will state in the contract specification that you have to use the Forex method, or you have to use Forex no leverage method, or you have to use the CFD exchange stock method, or you have to use the CFD leverage, or you have to use initial and maintenance margin. So we went through quickly. We went through all of them, and I showed you the formulas, okay? I showed you all the formulas. All right. So this is the fixed margin. We did that. So if we are using the fixed margin, that is when we have initial margin and then maintenance margin from our contract specification, then our margin is going to be volume in lot times our initial margin. That is for CFD, CFD stock, CFD index. Okay, but if it is Forex, the Forex is a bit different. With a fixed margin, if you have initial margin in your contract specification, then the margin is going to be volume in lot times initial margin. So at this particular point, it is not the contract size, but rather the initial margin, okay, over the initial margin over leverage. All right, and then we said that there are other additional parameters that they set for the calculation, okay? So you are going to see something like the margin rate. If you have that, what happens is that after you have done your calculation, you multiply it also by your margin rate. Okay, so we went through this, and then the example that we had over here, this was the answer that we had. So this was the answer. And then we went through how much you need to deposit, okay? How much you need to deposit to have a comfortable trading experience. And I said that this is not a strict rule. This is not a general rule. This is what we have given to our students. So for you to be able to trade any amount, or for you to be able to know the deposit to make, first you have to choose a lot size you want to trade. Second, you choose a reasonable leverage. And then third, you calculate for your margin using the parameters set by the broker. Okay, so after you have done your calculation, you use the current rate of Euro USD, you multiply it by the rate of Euro USD, and the answer you are going to get is going to be the least amount to deposit. However, to have a comfortable trading experience, you have to multiply that answer by 2. And when you do that, that will result in your suggested trading capital. So I gave you an example, and I also explained to you the need for all this, okay? So when we did all the examples, so I decided to trade one standard lot Okay, that is one lot size of Euro USD. The volume in lot size is 1, and then I choose a leverage of 1:500, as I explained yesterday to you, how to choose leverage. And then I calculate for my margin, okay, using the Forex method. I'm going to have my margin to be volume in lot times contract size over leverage times my open market price. I have added the open market price straightforward, so that I'm not going to do the calculation before I add it. Because Euro USD is having a direct rate, I just add it straightforward. When I do the calculation, my margin is going to be 226.462. And we say that this is the least amount that you need to deposit. 226.46 is the least amount that you can deposit, that you can trade with. A minimum of 226. If you are being deceived that you can deposit $50, you can deposit $100 and trade or have a comfortable trading experience, I am telling you, it has never worked for us. It has never worked for us. So it means that for a comfortable trading experience, I have to deposit not less than $400. And that is what I'm going for this time. I told you yesterday, and then I showed you with the risk calculator that we are working on. I showed you how it works, and all of us were excited when I showed that to you. So please stick to this particular way of knowing how much to deposit. I don't want you to call me and find out whether do I need to deposit $50 or do I need to deposit $100? I have shown you that with Pips and Profit Trading Academy, your deposit should not be less than $200. Please, just stick to this. $200. Have it ready. And I also told you that I'll be having a meeting with the CEO. Possibly we may have a welcoming deposit. We discussed that earlier this year, but Charlie, whether the deposit comes or whether the welcoming bonus comes or not, at least you should have your $200. If you have your $200 and then there is a welcoming bonus of, let's say, 20%, 10%, even 5%, it will just come to add up to your capital or your invested amount. So have that in your mind, okay? That you are not doing any deposit less than 100. Okay, I've said enough. I'm really passionate about this particular thing. I went through a lot. I asked a lot of questions. I interviewed a lot of people, and I got to know that this is the secret. This is the secret. Okay. And I used the trade I took on Friday to even illustrate to you how important this particular slide is. You can take a screenshot of it and keep it in your notes as well. I've spoken enough. A word to a wise is enough. Okay. And then we went through, we said that apart from margin, there are other things that we needed to know. That is, we needed to know balance, we needed to know equity, we needed to know free margin, we needed to know margin level. We went through all the explanations, so I'm not going through them again. And then I answered your questions. Okay, so today, what are we doing today? Today, we want to learn how to calculate for profit or loss. Okay? Oh, we did something yesterday about that. Yes, we did something yesterday. So yesterday, we learned about pips, we learned about pipettes, we learned about point. Okay? So we are going to go into point value, pip calculations. Okay? Oh, we learned pip calculations. Thank you. So pip calculation, we did how we calculate pips when the price moved from one particular price point to another. And then we also went into targets, how we use pips to set targets. And today we will look at how to calculate for profit or loss. Okay. So we said all the things that you needed to know about pips. We said all of that. So if you were not here, please, the link to the recording was put on the platform. You can access it. Okay, pips is an acronym for price interest point or percentage in point. And we said that a pip is the smaller unit in which a currency pair can change. And we said that it's not the currency pair changing, but rather the rate of the currency pair. Okay, so we made a correction over here. And I said that the pip is not the smallest. In some books, you are going to see the pip is the smallest. The pip is not smallest. When I did my research, I have realized that the pip is not the smallest. Okay, it is the standardized unit and the smaller amount by which a currency pair or the rate of a currency pair in a forex market can change. Okay, so we said that for a 5-digit decimal, which is 5 decimal pair, we went into our contract specification and we realized that some pairs can be 5 digits, some pairs can be 2 digits, some pairs can be 3 digits. Okay, so with a 5-digit pair, we said we calculate our PIP from the 4th decimal number, and then for 3-digit pair like the JPY, our PIP is the change in the 2nd decimal number. Somebody asked a question. Let me attend to that. Okay. Please, can I have the link to the platform? It is my first time joining. I saw the flyer on LinkedIn and decided to join. Hey, my boss is really taking me far. Thank you very much, Auntie Sika. Bismarck, please contact this number, WhatsApp me personally, and then I'll add you to the platform. We are not sharing the links, okay? We are not sharing our WhatsApp link because some people are trying to fish out information from us. So you can call me or you can WhatsApp me 0245-300-122. That is my personal number. Please, this number I'm giving out, it's for only Bismarck. Yesterday I gave it to Bills. He contacted me and then I added him. So you can also contact me and then I'll add you to the platform. Thank you very much. Antiska, thank you. Once my wife went somewhere and then somebody asked her, I'm seeing your husband's advert on social media. What is he doing? Me, myself, I don't know that I am on social media. By the help of my boss, Antiska, I am everywhere. Thank you very much. Women in Forex, you are doing great for us. Okay, let's continue. So we went through what a pipette is, and we said that a pipette is a fractional pip. Therefore, a pipette is the smallest unit. A pip is not the smallest. A pip is the smaller, and the pipette is the smallest unit. Okay, so for a 5-digit pair, a pipette is the change in the 5th decimal number, and then for a 3-digit pair, like the JPY pairs, a pipette is the change in the 3rd decimal place. All right, so we went through this and then we saw how the pips for 5-digit pairs looks like and how the pipette for 5-digit pairs look like. And then we went into the JPY pairs. They are the 3-digit pairs that we have. So we said that the change in the 2nd decimal number is the pipette, and then you can see the arrows over there. And then a change in the 3rd decimal number superscripted is the pipette. Okay, so we went through all this, and then we went through this, and we also spoke our pips and points. With this, I told you that because we had already tackled it when we're doing spread, we didn't do much about it. Okay, we said that on some trading platform, pips are expressed in points. In that case, you divide the point by 10 to get your pips. Okay, so for example, if on that particular platform a price moves 600 points, then that 600 points in pips is 60. Simply divide your 600 by 10, and then you are going to get your pips. Okay, so I answered the question. We did a pip calculation. So these are the two things that we did under our pip calculations. Finding the number of pips a pair has moved upwards or downwards from one price point to another price point, and then using pips to set targets. Okay, so finding the number of pips a pair has moved upwards or downwards, these are the ways you go through. One, you subtract the old, that is the initial or previous exchange rate price, from the current exchange rate price. Okay. Hey, Yaira, you also joined because of Antiska. I've been following her on LinkedIn. I have to get back to LinkedIn as soon as possible because I have a lot of people over there. Thank you very much. So all the colleagues from LinkedIn, you are welcome. I know some of you also saw the flyer and then you joined from other platforms. I'm grateful. Okay, so to find the number of pips a pair has moved upwards or downwards, you subtract the old exchange rate price from the current exchange rate, and then you divide the difference by 0.001 for all pairs with 5 digits, and then But for JPY pairs, that is 3-digit pairs, you divide by 0.01. If the difference is positive, the currency pair appreciated or moved upward. If the difference is negative, the currency pair depreciated. Okay, so we went through examples. For instance, GBP USD moved from 1.36611 to 1.36671. How many pips did the pair moved? We did that yesterday. So this is how it is done. You can take a screenshot. If you were not here yesterday, you take a screenshot of that. Okay. And then we did the second example for Euro USD. Euro USD moved from this particular price point to another price point, and we asked ourselves how many pips has that pair moved, and we did the calculation. We arrived at 32 pips. Okay, then we did another example for GBP JPY, and we said that with GBP JPY, and because it's a JPY, that is a 3-digit pair. What we did was that we divided by 0.01, okay, and then we had our answer over there. We did another example for AUD JPY, and when we did that also, we had our 178.8 pips over there, okay, and I answered your questions. All right, and we went into using number of pips to set target price point. Okay, so in Forex, there are 2 targets you always have to plan before you place a trade. Before you place a trade, you need to, please take notes, you need to plan for these 2 target points before you place a trade. And the first target is take profit. The second one is your stop loss. Okay, so what is take profit? We said that take profit is your targeted price point where your orders are closed in profit automatically or manually. So if you buy, the TP is where you sell to the market for profit. In same way, if you sell, your TP is the price level, your order is bought for profit. These are technical terms I explained to you yesterday. So if you don't have a take profit price point, then you have no business trading. I drummed this yesterday. I drummed it very hard. If you don't have a take profit price point, then you have no business trading. So you always have to analyze that. But I added that there are certain times that you can look at your take profit price point with your eyes. You can just gauge and say that if the market gets to this level, I'm going to close my trade manually. That one too is there. But as a beginner, try as much as possible. Please try as much as possible and always plan for your take profit before you place your trade. So you can say my take profit is 30 pips, my take profit is 50 pips, my take profit is 100 pips. At least be a trader. Be a trader. All right, you should always have your take profit well planned before you make an entry. So we said that always set your take profit. And then we came to stop loss. This is an order that defines your risk level. This is an order that defines your risk level. So it is your targeted price point that defines how much you are willing to lose. I told you that losing is inevitable when it comes to Forex. There are certain times that the trade will go against you. There are certain times the trade will bite you very hard. It will pierce your heart. So what do you do to protect yourself? You protect yourself by using what we call stop loss. So that is the price, the targeted price point that defines how much you are willing to lose in case the market goes against you. And this is the most important part of trading. So if you don't have a defined stop loss, you may lose or you may blow your entire account. I have accounts that I blew. I still have them in my videos because I didn't set stop loss. I blew those accounts. No, the truth is that if you don't set stop loss, your ego now takes over your emotions. So your ego will tell you that the market will reverse. I'm telling you, nobody defines where the market should reverse. All that we are doing are speculations. We are all speculating where the market will reverse. Nobody knew that oil will hit negative number. Last year or last 2 years or somewhere, nobody knew it. Okay? So you don't know where the market will reverse. You don't know where the market will get to. So always set your stop loss. I am repeating. Always set your stop loss. Okay. Now, I want you to tag somebody on the call. Okay, look at the participant and then tag the person's name and write always set a stop loss. So I will start with, I'm going to mention somebody's name, and then I will use the person's name to type to say this. So I'm going to say that Bismarck always set your stop loss. You can also use somebody's name. Always set your stop loss. Bismarck, always set your stop loss. Mention somebody's name and tell the person, always set your stop loss. Insia, always set your stop loss. Yes, always. Rex, always set a stop loss. Very, very important. So if we are trading together and then I look at your chart and there is no stop loss, you are not one of us. Thank you. So I said a lot of things about stop loss, and one of them is that stop loss will always give you a second chance. Even if you don't remember anything, stop loss will always give you a second chance. Okay, then we went into TPs, how you set your TP. So we are saying that if we are buying, we are anticipating price will go up. Okay, so if we are anticipating price will go up, then our TP is going to be up, and then our stop loss is going to be below our entry point. In that sense, if our TP is up, it means that we are adding, okay, for buys. If our stop loss is below, then it means you are going to subtract for buys. And for sales, we are anticipating that price is going to go down. So if price is going to go down, our take profit is going to be below. So if our take profit is going to be below, then what we are going to do is that we are going to subtract. Okay, we are going to subtract to get our take profit. And then our stop loss is going to be above. So we are going to add to get our stop loss. So we did that over here. We went through all the exercises. We went through all the exercises. Today, we are looking at point value and then pip value. Quickly, we are looking at point value. We are looking at point value and then pip value. This is very simple to understand. Okay, so let's go straight into it. What is a pip value? A pip value is the decimal value of the change in the exchange rate of a currency. That is a pip value. So if anybody asks you what is a pip value, it is the decimal value of the change in the exchange rate of a currency. And then the point value is the decimal value of the smallest change in the exchange rate of a currency pair. Okay, of a currency pair. Okay, and where do we get all these pip value and then the point value from? You infer from the number of digits stated in the assets contract specification. So for instance, when you go to your asset contract specification, okay, and then you see the digits. Yesterday we looked at it. So you see that they have written the digits to be 5 digits. Okay, 5 digits. What will be the pip value? What will be the pip value? You see, let's say 2 digits. What is going to be the pip's value or the point value? Okay, so let's go through that. Now, if the pair, okay, take note, if the pair has 5 digits stated in the contract specification, a point value, the point value is going to be 0.00001. So if the pair has 5 digits, so you see 5 digits, then the point value, okay, point value is going to be 0.00001. How many decimal places we have? 1, 2, 3, 4, 5. So we have 5 decimal places. Because we are having 5 decimal places, the point value is 0.0001. From our contract specification, if we have in our contract specification 5 digits, okay, then our point value is going to be 0.00001, and then our pip value, okay, pip value is going to be, so this is pip value. Our pip value is going to be 0.0001. Okay, so you can see that with 5 digits, we are having 5 decimal place for the point value, and then we have the 4 decimal place for the pip value. Okay, that is that. So let's try and do this for me quickly. Somebody is saying some of the pairs do have 4 decimal places. Okay, so if the pair has 4 decimal places, listen to me. For instance, let me react to this. If you have Euro USD, okay, and then it is having 4 decimal places, let's say 1.1345. This is 4 decimal place. What you need to do is that go and check from the contract specification. Okay, you have to go and check from the contract specification and see whether the digit you have over there is 4. If the digit you have over there is 4, then the point value is different. If the digit you have over there is 5, then it follows the same thing. It means that all the quotes you are having over there, the broker is only adding 000 at the end of the quote or the exchange rate. Okay, so if you have 4 decimal places for that particular pair, you have to go and check from the contract specification, because it is an algorithm that they have stated. It doesn't change. It follows the same pattern. Okay, it follows the same pattern. Any asset we trade in the financial market follows the same pattern. So if you want to know the correct pip value and then your point values, you have to always refer to your contract specification. Thank you very much, Derek. Okay, now let's continue with our slide. Okay, so this is how it looks like. This is how it looks like. So if in your contract specification, okay, if the digit is 1, then the point value is 0.1, and then the pip value is 1. If the digit is 2, then your point value is 0.01, your digit is 0, your pip value is 0.1. If your digit is 3, then your point value is going to be 0.001, and then your pip value is going to be 0.01. You can take a screenshot of this and keep it, okay, for knowledge. Then if it is 4 digits, then your point value is going to be 0.001. Okay, and then your pip value is going to be 0.001. Okay, so the 4, we have 4 decimal places, 0.001, and then the pip value is going to be 0.001. And then with 5 digits, you are going to have 0.00001 for point value, and then pip value, you are going to have 0.0001 for 4. Okay. All right. So take a screenshot quickly. Take a screenshot of this, and then we continue with the next slide. I have also been taking screenshots. So those who have not been taking screenshots, I told you yesterday to develop the habit of taking screenshots. So do that. Okay. Questions, please. If you have any question, ask. If you have any question, I want you to ask. Ask your question about pip point values and pip values. Ask your question right now, please. Ask your questions. Ask your questions. Quickly. I'm taking 2 questions, then I'll continue. Hot box for me. If my digit is 6, what do you think? What do you think will be my point value? My digit is 6. Derek, can you hear me? Is it clear? I hope what I did didn't interrupt with the sound. Okay, Isiana is saying that the point value is going to be 0.000001. Thank you. That is correct. 0.00001. Correct. Correct. 6 digits. Yeah, we are talking about 6 digits. So the point value is going to be 0.123456. So, and then the pip value is going to be 0.12345. As simple as that. So that will be your answer. Thank you. Okay. All right. Thank you. Thank you. Thank you. Thank you. Thank you. Okay. So let's continue. Let's continue with our slides. Yes, Yaira, you are right. Okay, so I've answered your question. Now, we are going to calculate for profit. Okay, we are going to calculate for profit. How do we calculate for profit? There are ways we go about this. Now, what we are going to do is that I'm not going to talk much about some of the things you are seeing on the slides, okay? But these are the ways we calculate for profit, okay? So before we get to that, we are going to learn about value per pip. And then under the value per pip, we are going to learn how we calculate for value per pip for direct rate, indirect rate, and then cross rate. Then after we are done with this, it is going to help us to calculate for profit over here. You can see that we have our point and then our pips value at this place. It's very, very important to get that concept, okay? So without wasting much time, let's go into it. Okay, so we are looking at value per pip. During the lesson, somebody asked me how much a pip is worth. Okay, so that is what we are looking at now. Now, what is value per pip? Value per pip is the currency value of 1 pip. Okay, value per pip is the currency value of 1 pip move of a currency pair. Okay, in calculation, the answer will always be in the base currency. Pay attention. In calculation, the answer will always be in the base currency. So, if the answer is in the base currency, and then the base currency is different from your deposit currency, then here too, we are going to apply a conversion rate. Okay, so for direct and cross rate, if you want the answer to be in the quote currency or your deposit currency, then you have to apply appropriate conversion rate. Okay, then the rate of the pair, in that instance, the rate of the pair can also be called our OMP. I explained that to you yesterday. OMP means open market price. These are technical terms that we want you to get it at this foundational level so that when you move forward, you are not going to worry yourself with these things again. So for buys, you use the ask price. We know what the ask price is. And then for sales, you use the bid price. Okay, so this is just a bit of an information. You can take a screenshot of it. You can take a screenshot. Okay, now let's continue. Now, the formulas for calculating for value per pip are grouped under the 3 exchange rates. So if we want to calculate for value per pips, we have formulas, and the formulas are grouped under the exchange rate. Those who were with us from our second lesson, we spoke about the exchange rate. So you have to revise your notes. I told you that it is going to be needed, and this is where we need it. So your exchange rate, if it is a direct exchange rate, the rate of pairs with USD as the code, okay, that is your direct rate. And then we have our indirect rate. This is the rate of pairs with USD as the base currency. So example, we have the USD CHF, USD CAD, USD JPY. They are all having indirect rate. That is if your deposit currency is in dollars. Okay, then we have the cross rate. Okay, so the cross rates are rate of any pair without the US dollar. Okay, so example, we have the Euro JPY, GBP AUD, NZD CHF. So all the calculations that we are going to do, they are going to be grouped under these 3 exchange rates. As simple as that. Okay. Now let's continue. Let's continue. Generally, this is the formula for calculating for value per pip. This is the formula. Value per pip, write it down. Generally, the value per pip is equal to pip value. Okay, your pip value over exchange rate. Over exchange rate. Yes, today too is an advanced class. So you can write that also as well. Now, when you have this general formula, we are saying that the answer would be in the base currency, okay? The base currency. So for answer to be in US dollar, that is the quote currency, okay? A conversion is needed. What do? You multiply again by the rate or the open market of the pair. Please pay attention. We are talking about calculating for value per pip for direct rate or pairs with direct rate. So example, a pair, a base currency paired with the US dollar. So if we have that, then the value per pip generally is this. Okay, it is that. So you can write in your note, value per pip for direct rate pairs is equal to pip value over exchange rate. And we are saying that when you do the calculation, the answer will be in the base currency. When the answer is in the base currency, if the base currency is different from your deposit currency, then you have to apply a conversion rate. So how do you apply the conversion rate? Here, you multiply by the exchange rate or the open market price of the pair. Okay? Now, for a currency which is paired with the US dollar, if it has 5 digits, the pip value is always 0.0001. That is 0.0001. Okay? So if we have a currency pair like this, and the currency has 5 digits, then the pip value is going to be 0.00001. So now we know how to get our pip value. And then we divide it by our exchange rate, and that is going to give us our value per pip. Let's take examples for clearer understanding. Okay, now this is what you need to write. When we have to put everything together, from here, this is what I expect you to write, okay? So value per pip for pairs like this. For pairs like this, this is the formula. We are going to have our value per pip to be 0.00001, and that is our pip value. Remember, that's our pip value. 0.001, which is the pip value, over the exchange rate. And you'll be given the exchange rate, okay? And you multiply it again by the exchange rate. Why are we multiplying it again by the exchange rate? We are doing so because that particular pair has a direct rate. It has a direct rate. We multiplied again straightforward by this because it has a direct rate. Okay, so you can take a screenshot of that as well. All right, now let's continue. Okay, so let's take an example. Let's take an example. So if I have an example like this, what is the value per pip of Euro USD at this price point? If I have Euro USD at this price point, what do you think is going to be the value per pip? And we said that the value per pip, we are talking about the monetary value of one pip move. Okay, so we have our formula to be this. This is our formula. So all that we need to do is that this 1.22000 becomes our exchange rate. So here, our exchange rate is 1.22000. So if I want the value per pip, what I need to do is that I will divide my exchange rate. I will divide by my exchange rate and then multiply it by the exchange rate again. When I do that, my value per pip for Euro USD is going to be this. It is going to be that. Okay, let me take it once again. Let me take it once again. If you are being given what is the value per pip of Euro USD at this particular price point at 1.220. Okay, we know that from our previous lesson, we know that value per pip, okay, value per pip, let me try and shorten it to be VPP. So VPP is equal to our pip value, okay, our pip value over our exchange rate. That is the general formula. However, the pair we are talking about, Euro USD, has a direct rate, okay? Because it has a direct rate, what we are going to do is that we need to use the formula, okay, that we have earlier. We are saying that if it has a direct rate, you multiply again by the OMP. And we said the OMP is the same as open market price. Open market price, which is in effect is going to be the exchange rate. So when we put all of them together, we are going to have our formula to be like what you are seeing over here. 0 divided by pip value, which is 0.0001, divided by the exchange rate times our exchange rate. Is my screen okay? Can you all see my screen very well? Let me see what you have written. Can you see my screen, or you can see some of the values? Can you see all the values? Can you see all the letters? Okay, thank you very much. All right, so when we put all together, our value per pip is going to be our pip value, which is this, our pip value, which is 0.001. Why is it 0.001? Because it is a 5-digit pair, okay? Because it's a 5-digit pair, we are having 0.001 divided by our exchange rate. This is our exchange rate times our exchange rate again. Why are we multiplying it by our exchange rate again? Because Euro USD is having a direct rate, okay? So if it has a direct rate, you are going to multiply it again by the exchange rate, and you are going to have this answer. Therefore, value per pip of Euro USD is going to be 0.001. So this is the value for 1 pip move with Euro USD at this particular price level. Okay, let us continue. Let us continue. Okay, so let's try this. I want all of us to try this. If you have understood what I just explained, try this for me. What will be the value per pip of GBP USD? GBP USD. Okay, GBP USD at this point. what will be the value per pip? If you understand what I have explained to you, I want you to type your answer there. Okay, somebody is asking, so 3-digit pairs will be 0.01. Yes, perfect. Thank you very much, Insian. We will come to that. Now, I want you to do this and give me the answer. What will be the value per pip for this pair, GBP USD, at 1.79750? What will be the answer? Do the answer for me. Please, get me the answer. 0.00001. Are you sure you did it well? Are you sure you did it well? 0.001, 0.001, 0.001. Very good. That is the answer. The answer is 0.001. Very simple. Now, after we've gone through this, you are going to see why the answers are the same. You realize that the answer we had for Euro USD is the same as the answer we are getting for GBP USD. Why? Why is it like that? So we are going to know it very, very soon. Okay, so this is the calculation that we have over here. GBP at this value. So our value per pip is going to be 0.001 divided by exchange rate times the exchange rate. When we do that, we are going to get 0.00001. Therefore, value per pip of GBP USD is going to be 0.0001. As simple as that. Okay, let's see if we have more examples. Let's see if we have more examples. Okay, so let's conclude over here. We don't have more examples. When we did the calculation for Euro USD, we had 0.001. When we did the calculation for GBP USD, we also had 0.001. In conclusion, for a US dollar account, the value per pips for any pair, okay, any currency paired with the USD, okay, the answer for your value per pip is always 0.001. Let me take it again. In conclusion, for US dollar account, the value per pips for pairs with the rate, with the direct rate, that is a pair, any currency paired with the US dollar as the code, your value per pip is 0.001. So let me try and list the examples for you. So when you take AUD USD, okay, your value per pip is going to be 0.0001. When you take GBP USD, your value per pip is going to be 0.001. If you take NZD USD, your value per pip is going to be 0.001. So you can see that with all these pairs, we have the other pairs, you can mention them. AUD USD, at this particular point, USD is the code. Here to USD is the code. Here to USD is the code. Here to USD is the code. Because USD is the code and your account is a US dollar account, you are going to have the same value per pip. You are going to have the same value per pip. So take note of that. Take note of that. You can take a screenshot of what I have done, and it is going to help you understand when you are revising. Okay, let's go to the next type of rate. Oh, let me clear my screen first. Okay, if anybody has a question, the person can jot it down for me. Okay, if you have any question, you can type it down for me. If you have any question, value per pip for pairs with direct rate, they are equal, and they are equal to 0.001. So I can quiz you on that, and you should be able to tell me. Okay, if there are no questions, then I would want us to continue. I want us to continue with the next slide. Okay. Okay. Now let's go to indirect rates. Let's go to indirect rates. So we have explained the direct rate. We are going to indirect rate. Okay, indirect rate. Now, if we are having indirect rate, our general formula for value per pip is this. This is the general formula. So value per pip is equal to pip value times our exchange rate. Okay. Now, with this indirect rate, look at how the pair is being written. Here, we are having the USD paired with another currency. So at this point, our base is US dollar. The base is US dollar. So since the base is US dollar, the base currency is US dollar, there is no conversion over here. So here we are not going to multiply again by the exchange rate. Here we are not going to do any additional multiplication. This one takes the raw general formula. Okay, so if the pair has 5 digits, then the pip value for that particular digit is 0.001. And then if the pair has 3 digits, example JPY pairs, then the pip value for that 3 digits is going to be 0.01. So you have to put that in your mind, because we are going to use that to do the calculations. Okay, let's continue. Let's go to the next slide and see what is happening over there. Okay, so this is the formula. You can write it down. This is the formula. Okay, so for 5 digits, the value per pip, if it is it has an indirect rate, is going to be 0.0001 over exchange rate. That is it for 5 digits. But if it is a 3 digit, then we are going to have 0.01 over the exchange rate. At this point, I want to pause and ask. Okay, Yaira is asking a question about the direct exchange rate. Please, can we say all direct exchange rates have their value per pip to be 0.001? Yes, I said it. Yaira, I said it. Thank you very much. I said it. You like asking questions, and I like that. Thank you. You and then Isya and another person. So the person knows him or herself. Okay. So that is that. Now, let's take this. I want to quiz you. Assuming our digit from our contract specification, if our digit is 4, if the digit is 4, what will be the value per pip? What will be the formula for our value per pip? Our value per pip. What will be the formula if our digit is 4? If our digit is 4. What will be the value per pip? What will be the formula? The formula. Write it for me. I want you to write the formula. Our digit is 4. Okay. So if our digit is 4, then our formula is going to be 0.001 divided by the exchange rate. Thank you very much. 0.001 divided by exchange rate. Thank you very much. Perfect. I'm waiting for one person. The person has not answered. I'm waiting for one person. Maybell, you are the one I'm talking about. Maybell. You know I will mention your name. Maybell. Maybe it is not here, so Maybell, talk.
Mabel, write your answer down. Okay. Yaira, you like short hands. Bam. All right, that's cool. So that is that. You are correct on that. So let's take examples. Let's take examples. Now, I want to emphasize that when you get this concept, okay, you can calculate for profit of any asset on the financial market. Why am I saying this? When you take gold, for instance, let me digress a little. When you take gold, okay, when you go to the contract specification for gold, you are going to see something like 2. You are going to see the digit to be 2. So if the digit is 2, then the value per pip is going to be 0.1 over the exchange rate or over the price you have over there. So with this, nobody is going to, you are not going to get confused. All that you need is your digit, okay? And I told you that the brokers, they differ in the parameters they set for their assets. So gold, for instance, there are brokers, you are going to see them, the digit is 2, and then the contract size is 10. Other brokers, you are going to see the digit to be 2, and the contract size is 100. Other brokers, you are going to see the digit to be, I think 1, the digit is 3, and then the contract size is even 1. So when you understand the concept I'm giving to you right now, you can apply it with any financial instrument, be it cryptocurrency, be it metals, be it energy, be it stocks, be it synthetic indices, whatever asset that you chance on. All that you need is go and visit the contract specification and get the number of digits. When you get the number of digits, you'll be able to calculate the value per pip of that particular instrument. As simple as that. So this is a general rule. If you care to know, that is an information that I want to give you. Okay. So let's continue. Let's go to examples. Okay. Let's take examples. All right. This is an example we have. So what is the value per pip of USD CHF at this particular price point? Okay. So we have USD CHF at this price point. Now, USD CHF is a 5-digit pair. So this is a 5-digit pair. The pip value is going to be 0.001. And then our value per pip, the formula is 0.001 divided by exchange rate. We can write it in this way. So when we put our figures together, okay, or when we put our figures in the formula, we are going to have 0.0001 over the exchange rate, and this is going to be the answer. This is going to be the answer that we are going to have. Okay. Now, when I give you an example, you need your calculator. Okay. You need your calculator. So please, I'll give you an example very soon. Then you do that for me. All right. Here, you won't be able to use your mind to get the answer. You have to use your calculator. Okay. All right. So let me take it once more for those who didn't get it. This is an indirect rate. Okay. So we are looking for the value per pip of USD CHF at this particular point. Now, USD CHF is having 5 digits. Because the 5 digits pair, our pip value is 0.0001. Okay. Now, value per pip, our formula is 0.0001 divided by the exchange rate. So because we have that, we know our pip value, we know our exchange rate. So when we insert the formulas and we do our calculation, this is what we are going to have. Therefore, the value per pip of USD CHF is going to be this. And this is the value of one pip move. Okay, 1 pip move. That will be the value. Okay. Now, we are going to try as much as possible to add the number of pips to help us know how much these smaller answers we are getting, they compound or they increase in value to give us the amount of money that we always look for. All right. Let us take the next slide and see what we have. So let's take this as an example. I want you to do this example for me. USD card. I want you to do the calculation for me. what is the value? What is the value per pip of USD CAD at this particular price point? I want you to do the calculation for me quickly. Take your calculators and do them. Take your calculators and do them for me. Take your calculators and do them for me. What will be the answer? There are some particular people I've not seen their answers. Let me see. Ronnie Gold, you've not said anything. You've not written any answer for us. Please write some answers for us. Okay, Isian has put in his answer. What is your answer? At least I want not less than 5 people to get it correct. Okay, so 0.000067159. Wow. At least 3 people. Rita, thank you. 3 people. So let's see if our answer is correct. Let's see from the slide. Very good. You had it. Thank you, guys. You had it. Your answers are correct. Thank you very much. You are making me a proud lecturer. Thank you. Okay, so let's take another example. Since you had it correct, I don't need to talk much about it any longer. Let's take another example. Now let's do this example. What is the value per pip? What is the value per pip of USD JPY? So what you need to note over here is that this is USD JPY, and then USD JPY is having how many digits? It is having 3 digits. Okay, 3 digits. So if it has 3 digits, for indirect rate, if it has 3 digits, we are going to use 0.01. That is what we are going to use for our calculation. So I want you to do this for me. Try it for me. For 3 digits, our pip value is 0.01. So I want you to try it for me. Gideon, you said you didn't get it. Where? The first example that we did. The first example, please punch your calculator very well. You get it. Okay, so I am having 2 answers over here. 3 answers now. 3 answers now. Okay. I'm waiting for somebody. The body knows him or herself. That somebody should do something. Somebody, or the person has already answered. Wow, this is massive. This is awesome. Massive. You are all getting the answers for me, and I like that. Okay, so let's go to the slide and see the answer we have. Wow, perfect. So we are having 0.000834711, a lot. Okay, so if we are to limit ourselves to this, just 3 countable numbers, then we are going to have this. Guys, I'm proud of you. I'm very, very much proud of you. Thank you very much. Okay, let's go to the next slide. So in conclusion, for US dollar account, the pip value for pairs with indirect rates, they vary. Please. So if anybody tells you that the pip value for all Forex pairs is 0.0001, the person is lying to you. The pips value are different when you come to indirect pairs. So what does that mean? It means that for indirect pairs, pairs with indirect rates, if you have a US dollar account, okay, so USD CHF, USD JPY, USD USD what? What is left? USD card. Now, these pairs you see over here, if the base is US dollar, their pip value per pips, their value per pips are not the same. They are not the same. So here, value per pip, value per pips are not the same. They vary. It means that when you are trading these assets, okay, if for instance you make, let's say, 30 pips on this, 30 pips on this, 30 pips on this. Now, if you make 30 pips on both of them, your values, your profits are not going to be the same. So for instance, if USD CHF, your 30 pips is giving you, let's say, $100. USD JPY, your 30 pips may give you something like maybe 120. And then the US card, your profit is going to be something like 90. So they are not the same. They are not the same. The value per pips for USD as a base currency paired with another currency, the value for their pip values are not the same. The value per pips are not the same. Somebody said we have USD RUB. Thank you very much. Yes, the person is taking us to Russia. Don't worry. We will go to Russia sometime to come. Okay, so that is what I want you to understand. Okay, that is what I want you to understand. When you take some courses, they put all of them together, and then what they will tell you is that the value per pip, one pip for one lot size is, they will tell you it is 10 for one lot. Okay, they will tell you one lot is 10. Then a mini lot, this is standard lot. They will tell you standard lot is 10. Then they will tell you mini lot is 1. And then they will tell you micro lot is 0.1. Please, these calculations you see over here, they are not correct. They are not correct. If anybody asks you, tell them that the Chancellor of Pips and Profit Trading Academy is saying that the values over here are different. Okay, they are different for USD paired with any other pair. Now, when we advance, you are going to see why they all use this analogy to explain the values of Pips movement in the Forex industry. You are going to understand that. But I want you to be aware that what they have said, it's not the entire truth. Okay, so let's continue with the next. The last exchange rate type, that is the cross rate. Let's look at the cross rate and then we continue from there. Okay. So the last one we are talking about is the cross rate. Okay. Cross rate. And we are saying that with the cross rate, okay, we are talking about two pairs without, we are talking about currency pairs without the US dollar. If the dollar is your deposit currency. Okay, so the cross pairs are pairs that have no USD in them. An example, we have this, we have that, we have that. Okay, generally, this is the formula for value per pip. This is the formula for value per pip. This is the general formula. Okay, however, with the cross pairs, there is what we call the conversion that we need to add. Okay, so if the pair has 5 digits, the pip value for that 5 digits is this. We have spoken about the pip value. This is the pip value. So if you want to get your pip value, you have to use your digits to get your pip value. And then if the pair has 3 digits, then the pip value is going to be 0.01. The answer is going to be in the base currency. Okay, the answer is going to be in the base currency. Because the answer is the base currency and the base currency is not your deposit currency, a conversion rate is needed. A conversion rate is needed. Okay, and then the conversion rate you are going to use are going to be the cross exchange rate that you are going to use. So let us look at how we do that. We did that yesterday. We went through how to convert, okay, using the cross pairs. You remember what I said? If you are converting, if you are trading the euro crosses, you know what to multiply. If you are trading the GBP crosses, you know what to multiply. If you are trading the CAD crosses, you know what to multiply. But for the sake of those who are not here, let us try and then help them. Okay, so generally, this is the general formula for this is the general formula that I want you to put down. Okay, before we go into the conversions. So value per pip for cross pairs. Okay, this will be the formula. Value per pip is equal to the pip value divided by exchange rate. Then you multiply your cross rate. When we were talking about the margin, we apply this principle, so you know it. Okay, now I want you to write in the chat box that for cross pairs, write it for me. For cross pairs, okay, value per pip is equal to what we have over here. Write it in the chat box for me. For cross pairs, value per pip is equal to pip value times exchange rate times conversion rate. Write it in the chat box for me. I want 3 people. 3 people should write that for me. 3 people should write that for me quickly. 3 people write in the chat box for me that for cross pairs, value per pip is equal to pip value over exchange rate times conversion rate. Write it for me. Hurry up. 3 people. Where are my 3 people? Insia, thank you. The next person. Primus, thank you. The last person, Rita, thank you very much. Rita, thank you very much. Okay, so let's continue from here. Now let's take examples. So if we are to take example, it is going to be like this. Okay, it is going to be like this. What is the value per pip of Euro GBP at this level if Euro USD is this? Now, try and do the answer for me. Try and do it for me. Try and work it for me. Try and work it for me. We know that for euro crosses, if we are doing any conversion, okay, if we are trading euro crosses, remember yesterday we said that you multiply by the rate of euro USD. So that is why you are having the conversion rate over here. Who has done it? So let's see. Please do the answer for me. We want the value per pip. And we are saying that our formula for cross pairs, okay, for cross pairs, value per pip is equal to our pip value divided by our exchange rate, and then we multiply it by our conversion rate. So this is the formula, conversion rate. So I want somebody to do the answer for me. Get the answer for this for me. If you understand it, try and get the answer for me. Okay, 0.000135. I need another answer, then we go into it. Another answer. The last person too. The next person is here. Wow. Go. Jacob also had the same answer. So let us look at it. Let's look at it. Let's look at it if the answer is correct. Okay. So thank you very much, guys. You had it. You had it. So let's see how we go about it. We are having Euro GBP at 0.83540. It is a 5-digit pair. For that matter, our Pip value is going to be 0.0001. And generally, our formula, the general formula is this. Okay, so we can do it this way. You can do your calculation without multiplying the conversion rate. And when you do that, what is going to happen is you are going to have your answer in the base currency. Okay, so after you've gotten your answer in the base currency, you convert that answer into US dollar, and by that you multiply it by the rate of Euro USD, and the rate of Euro USD was given as 1.127. That is an example. So when you do it very well, you are going to get your answer correct. So those who did straightforward, that is Pip value over exchange rate times our conversion rate. You had it straightforward like that. Now let's take another example. When I'm done, I'm going to give you the good news about this whole calculations that we are doing. Okay? Yes. Let's take this example. Do this example for me. I want you to do this example for me. Try this example for me. I want 2 people. Okay, here is saying, please, yesterday I heard about the inverse of something. Those who are not here, for the benefit of those who are not here, let's go back to the conversion rate. So we are saying that with the conversion rate, if you are trading, let's say, Euro crosses, okay, Euro paired with any other currency, you multiply by Euro USD, the rate of Euro USD. If you are doing GBP crosses, that is GBP paired with any other pair without the US dollar, you multiply by GBP USD. For those who are not here, this is the conversion rate. And then if you are doing AUD crosses, you multiply by AUD USD. And we said that with card crosses, example, card CHF or card JPY, you multiply by the inverse, okay, the inverse of USD card. I think when I was doing the recap, I even said it. And then CHF, if you have CHF paired with any other pair, like CHF JPY, you multiply by the inverse of USD CHF. Okay, that is what I said. All right, so those who are not here, okay, I'll put the conversion table on the platform for you. So if you are not here, don't worry about that. Okay, thank you very much. I have gotten 2 answers, and the 2 answers are similar. Okay, so let's see what the answer is. All right, so your answers are very similar to mine. Let's see what you did. Okay, so we were giving Euro JPY at this particular price point. So we know that Euro JPY has 3 digits. So because it has 3 digits, the Pip value, our Pip value is going to be 0.01. So generally, this is the formula. Okay, this is the formula. So when you go step by step, you are going to have your Pip value divided by exchange rate. So 0.01 divided by this, we are going to have something like that. And then after that, because it is a cross pair, there is a conversion. And the conversion rate is the Euro cross. Okay, Euro crosses. So the Euro cross is the conversion rate. We are using Euro USD. And Euro USD was given to us as this. So because Euro USD was given to us as this, we can multiply that by the answer we had over here. Now, when you do it straightforward, you are going to have it like the Pip value, which is 0.01 multiplied by, 0.01 divided by the exchange rate 132.15. Then you multiply it by the conversion rate, which was given as 1.17190. Okay. Now, these calculations we have done are the calculations that we are going to use to calculate for our profit. Okay. We are going to calculate for profit for standard lots, profit for mini lots, and then profit for micro lots. So pay attention. Okay, let's see if we have more examples. If we don't, okay, the last example. So now we are having USD card over here. Okay, we have card CHF. I was talking about card in the example. So we have card CHF over here. Now, what is the value per pip of card CHF at this rate? So I want to give you the explanation, then you use it to get the answer for me. Now, card CHF is also a cross pair because you are not having the USD in it. Okay, so it means that our value per pip is going to be our pip value over exchange rate, let me make it ER, times the conversion rate, let me make it CR. Okay, so how do we get the pip value? The pip value, we can take it from the number of digits. Here we are having 5 digits. So since we have 5 digits, the pip value is going to be 0.0001. Okay, and then we divide it by the exchange rate. The exchange rate we have over here, card CHF, the exchange rate we have is 0.72572510. Then we multiply it by the conversion rate. So for card crosses, we said that if it is card, then you are going to multiply by the inverse rate, okay? The inverse of USD card, the inverse of USD card. So this is USD card. The inverse of USD card simply means that you divide 1 by the rate we have over here. So you divide 1 divided by 1.2761 will give you the inverse rate of this particular thing over here. Okay, I don't want to bore you. Let me go through. Let's go to the next slide to explain more. Let's go to the next slide to explain more. So this is what we have over here. In summary, we are looking at card CHF at this particular point. The digit is 5. So our point value is there. Generally, this is the formula. Okay, this is the formula. So when we use the general formula, our answer is going to be in card. Okay, it's going to be in the Canadian dollar. That is the base currency. So if it is in the base currency, this is different from our deposit currency. So the conversion rate of card crosses is the inverse rate of USD card. Okay, so if USD is this, then the inverse rate is going to be 1 over this particular rate, and you are going to have something like this, 0.78363. Okay, so when you do that, after you have gotten the rate, you multiply it by the answer you had, and you are going to get this particular answer. Okay, all right. So just take a screenshot of this. Let me clear the screen, and then you take a screenshot of it. It is going to guide you. It is going to guide you when you see some of these things, and then you want to do your calculation. Now, let us now look at what that means. Let's look at what that means. So all the calculations we have done are for the cross pairs. Now, you can see that all the calculations we've done so far, we've not had similar answers. We've not had the same answers across. So let's go back. We did a calculation for Euro GBP. We had 0.00135. We did a calculation for Euro JPY, and we had a different figure, 0.084. We had a calculation for USD CAD, and we have a different answer also for that. So in conclusion, okay, the value per pip for cross pairs will vary. They are also not the same. So if anybody tells you that when you are trading CAD CHF and then you are trading USD, when you are trading Euro JPY and you are trading, let's say CAD CHF, and you are 30 pips in profit each or 100 pips in profit each, your value per pip or your profit is going to be the same. The person is lying to you. Your profits are going to be different because when it comes to the value per pip for cross pairs, they are not the same. All right. So if you have any question, give me the question. Let me answer you. Thank you very much. Thank you very much. Somebody did it. Jacob had it correct. Analysts had it correct. Insia also had it correct. You guys are really following. Thank you. I'm grateful. Thank you. Okay. So questions. If you have any question, please ask. Ask. If you have any question, please ask. I would encourage you to always stay through till the end of the class. Okay? I am the one teaching. I haven't gotten tired. So you, the student, you too don't get tired. Huh? Okay. Now let's go to value per pip per lot. What answer we had for value per pip? If we are now pairing it to the micro lot side, then we are going to just multiply it by 0.01. As simple as that. I've explained that. So I know that we are not going to spend much time going through that. So just pay attention. Thank you. So let's look at it. Very simple. Very simple. Okay. So value per pip per lot is equal to your value per pip times volume in units. Volume in units. Okay, volume in units. We did that. We did volume in lot size. Volume in lot size. And then we did volume in units yesterday. Volume in units. Okay. So generally, value per pip per lot is equal to value per pip times the volume in units. Therefore, when we break this down, value per pip per lot size is going to be the pip value over exchange rate times the volume in lot size. So, for instance, if we are using standard lot, okay, standard lot, and the pair has 5 digits, it means that the volume in units is going to be 100,000. Remember that. And then if we are using mini lot, okay, mini lot, we said that in units the volume in units is going to be 10,000. And then if we are using micro lot, the volume in units is going to be 1,000. So you have pip value times divided by exchange rate times your volume in units, and then you are going to have your value per pip. So to guide you, when you add the volume in units to your value per pip formula, then you are getting your value per pip per lot size. We are not going to spend much time over here. We are not going to spend much time here. So let us continue. Okay. I'm going to read through. You take screenshots and then you learn that later. So just as I explained, value per pip per standard lot. Okay. Since the general formula is value per pip over exchange rate times the volume in units, value per pip per standard lot is going to be value per pip times your standard volume in units. Your standard volume in units. And the standard volume in units per our contract size is going to be 100,000. Okay. So in that instance, value per pip per standard lot is going to be this particular formula over here. Pip value over exchange rate times our 100,000 units. And then value per pip per mini lot, okay, is going to be the value per pip times mini lot or mini volume in units. So mini volume in units is 10,000. If our contract size, if our ticket is 5, and then our contract size is 100,000. So the formula now becomes pip value over exchange rate times our 10,000 units, which is the unit for our mini lot or the mini volume. Then per micro lot, the micro lot value per pip, okay, times the micro volume in units. So in effect, this is going to be the formula. Okay, we said that conversion rate is applied when dealing with direct and cross rate. So you have to also put that in your mind. You can take a screenshot of that. Maybe it will guide you in future. Okay, I'm going to speed up, okay? When you get the recording, then you pay attention to the details that I'm giving you. We have run out of time. We have less than 15 minutes, so I have to speed up. You will get the slides. So when you get you will get the recordings. When you get the recordings, then you fill in all the gaps that maybe you left in your notes. Very, very important. Okay. So the same way we did for value per pip when we were dealing with the rate, okay, we are going to use the 3 types of rates. So here we are looking at value per pip per lot size under direct rate. Under direct rate. Here you multiply again by the exchange rate. So value per pip per lot, okay, value per pip per lot size, okay, with direct rate, this is the formula. Pip value divided by exchange rate times volume in units times exchange rate. This is a lot. Okay, so when we go down to the various lot sizes, we have value per pip per standard lot. For standard lot, you are going to have value per pip times standard volume in units. Okay, in short, value per pip times standard volume in units. And because we are dealing with because we are dealing with direct rate, you are going to multiply it again by the exchange rate. That is the OMP. We have said that OMP is the same as the open market price, and in effect, it is also the same as the exchange rate that you have. Okay, so when we put that in perspective, then our value per pip per standard lot is going to be pip value divided by exchange rate times our standard volume in units, then we multiply again by the exchange rate. Now, when you do it carefully, you are going to see that in this particular instance, the answer is going to be very simple because this one is going to cancel this. So all that you are going to have is going to be pip value times your standard volume. But that is not what I want you to get. This is for those who understand mathematics very well. Okay, so those of us who didn't do mathematics much, stick to this. Okay, all right. So let's go. Value per pip per mini lot. The same approach. We are going to have value per pip times mini volume in units, and because we are dealing with direct rate, you multiply again by the exchange rate. So we are going to have pip value divided by exchange rate times your 10,000, which is the unit for mini volume, and then you multiply again by your exchange rate. The same applies to micro lot. Okay, micro lot. So we have value per pip times micro volume in units. Okay, micro volume in units. So when you have it like that, because you are dealing with direct rate, you multiply again by your exchange rate. So in effect, this is what the formula is going to be. Okay, so that is that for you. A lot of information over here. Let's take the next slide and see what we have. So let's take examples. So if we have, we go back. If we go back, okay, to the examples that we use when we're dealing with the value per pip, okay, when we're dealing with the value per pip, we are not going to do the calculations all over again. We are going to use the values that we had when we calculated for value per pip. So, for example, Euro USD, okay? When we did Euro USD at this particular point, the value per pip for Euro USD, we had 0.01. Okay, 0.01. So for this, if we want the value per pip per standard lot, then we are going to have our value per pip, okay, the formula, value per pip times the volume in units. This is the volume in units, and you are going to have 10. When you do that, your answer is going to be 10. When you do value per pip per mini lot, okay, mini lot, we have pip value, okay, that is our value per pip. We had it over here. Then you multiply it by the volume in units. For mini lot, we have 10,000 units. When you do that, you are going to get 1. For value per pip per micro lot, when you do the micro lot, we are going to have the answer to be 0.1. Okay, so this is for Euro USD. This is for Euro USD. Let's look at the other pairs that we calculated their value per pairs. Okay, the other pairs, GBP USD. Okay, so GBP USD is here. When we did the calculation, okay, when we did GBP USD at this particular point, or at this particular price point, okay, our pip value was also 0.01. And when you do the calculation, you are also going to get 10 for standard lot, and then you are going to get 1 for mini lot, and then you are going to get 0.1 for micro lot. Okay, micro lot. It means that when you are trading one standard lot, okay, one standard lot for direct rates, that is pairs with the USD as the quote currency, one pip move is going to give you $10 if your account is a dollar account. If you are trading GBP USD, okay, and you trade GBP USD, which has a direct rate for one standard lot, okay, for one pip, you are going to earn $10. For mini lot, that is 0.1. For one pip move, you are going to earn $1. And when you use micro lot, for one pip, if you are trading GBP USD, your account is a US dollar account. So GBP USD has a direct rate. For one pip, for micro lot, you are going to have $0.1. Okay, so that is that. Now let's look at the next one that we did, the next example that we did, the next example. Okay, so when we go into this is a question that I want you to do for me. I want you to do this question. If you understand all that we have said, I want you to do this question. If the rate of AUD USD is this, what is its value per pip per standard lot, value per pip per mini lot, and value per pip per micro lot? You can try that. You can try your hands on that. You can try your hands on that. Okay. When you do that, okay, for standard lots, you are going to get $10. We are pressed with time, so let me go straight. And then for mini lots, you are going to get 1, and then for micro lots, you are going to get 0.1. So that is going to be the answer. Having said that, what does that mean? In conclusion, it means that when you are trading any pair, okay, any pair, and the US dollar is the quote, okay, is the quote. That is, let's say, Euro USD. We have done Euro USD. We have done GBP USD. We have AUD USD, AUD USD. We have NZD USD. When you do that, okay, your value per pip per standard lot, that is a pip move, one pip, Okay, 1 pip. 1 pip is going to be $10. So when you are trading standard lot, and then your pair is has a direct rate, then 1 pip is $10. If you are trading the mini lot, your 1 pip move is going to be 1. Mini lot, your 1 pip is 1, and then your micro lot, your 1 pip is going to be 0.1. Okay, so if you are with me, for instance, if I'm trading if I'm trading AUD USD, and then my take profit is, let's say, 50 pips, okay? Take profit is 50 pips. Then I trade 1 lot size, so 1 standard lot. I trade 1 lot size. What do you think will be my profit? What do you think will be my profit? What do you think will be my profit? Write the answer there for me. I am trading 1 standard lot. My take profit is 50 pips. Okay, that will be $500. Thank you very much. $500. Thank you, Isia. Excellent. Okay, so if I am trading the mini lot, and then my take profit is 50 pips. How much, Jacob? I like your emoji. Mini lot. What do you think will be my profit? 50 pips. Mini lot. What do you think will be my profit? Mini lot. $50. $50. Thank you, guys. Thank you. That is it. $50. So that will be 50. And then the micro lot, I'm going to have my profit to be 5. Okay. So now we've even learned how to calculate profit right away from this side. So when we get to that level, we are not going to spend much time. Thank you, guys. Okay. So that is for the AUD USD. We've spoken about that already. All right. So in conclusion, this is what I want you to take home. In conclusion, with a US dollar account, for any pair where the US dollar is the quote currency, that is, the pair has a direct rate, then your value per pip per standard lot is going to be $10. It means that 1 pip, your 1 pip is going to give you $10. And then your value per pip, okay, for mini lots, that is 1 pip is going to be $1. Okay, 1 pip is going to be $1. And then your value per pip per a micro lot, that is 0.01, you are going to have $0.1. Okay, so that is that. You can take a screenshot of this, and that will be a guide to you. So now we want to go to the indirect rate. Okay, so the indirect rate, I will rush through it as well. Okay, now this is the indirect rate. It's the same formula. Okay, so for USD being the base paired with another currency, that is indirect rate, no conversion is needed. Okay, no conversion is needed over here. So at this particular point, previously we said that your value per pip per lot size, if it is direct, then we are going to add the exchange rate again. But if it is indirect, then the exchange rate will be gone. Okay, so when we do that, these are the formulas that we are going to have. For value per pip per standard lot, this is going to be the formula. Okay, and for mini lots, this is the formula. For micro lots, this is the formula. Okay, so let's take examples. We are not going to use any different examples. We are using the examples we have calculated their value per pips already, so that we can go through this quickly. Okay, so these are the examples. These are the examples that we have. Okay, so for USD CHF, when we did the calculation, the value per pip was at this. Okay, the value per pip was at this. Now, if we want the value per pip per standard lot, that is, if I trade one standard lot, okay, the value for that one pip move, if I trade one standard lot per the calculation that we did, this is going to be my answer. So you can see something here. You can see that this number here is even less than one standard lot of the direct rates that we calculated. Okay, and then for micro, when we do the calculation, we multiply our value per pip by our volume in units, we are going to get this. And then the micro lot, okay, micro lot, we are going to get this. Now, when we go through this, it will give you a sense of which pairs you have to focus on. All the pairs will not give the same value. Some will give you less and others will give you more. So when you understand this concept that we are giving you, you'll get to know that even if I am supposed to choose a trade, I have trading opportunity. Let's say GBP USD, I have the same opportunity, GBP USD and then USD CHF. The best I can do is to trade the GBP USD. Why? Because with the GBP USD, if I trade one standard lot, I'm going to get $10 per pip. But when I trade USD CHF, I'm going to get 6. So GBP is going to give me more, and then the USD CHF is not going to give me that much. Okay, so that is that for the USD CHF. Let's go to a different indirect rate pair with indirect rate, okay, and see what is happening. Okay, so USD card, we did the calculation for USD card, and then we had the value per pip to be this. So if you want value per pip, that is one move, the value for one move. If I trade one standard lot, one pip, okay, if I trade one standard lot of the USD card, I'm going to get this as my profit for one pip. If I trade a mini lot, I'm going to have this as my profit for one pip. That is a mini lot. If I trade a micro lot, I'm going to have this as my profit. So you can also see that the USD card is also different from the USD CHF. The answers are not the same. Okay, let's go to the next example. Forgive me if I'm rushing through the slides. You can take screenshot. Okay, so this is USD JPY. So for USD JPY, when we did the calculation, we had our value per pip as this. Now the value per pip for standard lot, that is for one pip move, the standard lot of USD JPY, we are going to get this as the monetary value. And then for mini lot, we are going to have 0.834. Remember how we got the answers. And then for micro lot, we are going to get this. Remember how we got the answers. Okay? We remember, try and remember how we got the answers. All right. Let's go to the next one. This is indirect rate. So after the indirect rate, we have to look at the direct rate. Okay? We are done. Don't worry. We are done. Don't worry. We are done. Okay. So this is an example that I wanted you to take, but because we are pressed with time, I'm not going to give you that room. If the rate of USD JPY is this, what is going to be 8 value per pip per standard lot, value per pip per mini lot, and value per pip per micro lot? You can take a screenshot and then you try it. Okay, I have the answer in the next slide, but what I'm going to do is that I'm going to skip that slide. So take a screenshot of this. You try it. Okay, you try it on your own. When you try it on your own, you compare it with the answer that I am going to show over here. I'm not going to take you through the answer because we have done that already. So this is going to be the answer. Okay, try and see if you are going to get the same answer as the ones that we are having over here. Now let's conclude. Let's conclude on the indirect rate. Let's conclude on the indirect rate. Okay, so in conclusion, for a US dollar account, the value per pip per any lot size for USD paired with any other currency, their value per pip per lot are not the same. they are not the same. Okay, they are not the same. Okay, so I'm not taking questions now. Let's go to cross pairs. Now, with the cross pairs, what you do is that the cross pairs are also going to be like the direct pairs, but with the cross pairs, we are going to use the cross conversion rate. So you should know the conversion rate. If you know the conversion rate, you are going to be able to do any calculation over here. So this is the formula. If you want to calculate value per pip per lot size, this is the formula. We are going to have the pip value divided by exchange rate times volume in unit times our conversion rate. So you know the conversion rate to apply. Okay. Remember that when we have pip value divided by exchange rate, what we are saying is that that particular formula, this formula in brackets, is going to give us the value per pip. We have done that already. So for value per pip per standard lot with cross rates, okay, we are going to have the value per pip times standard volume in unit, and then you multiply it by your conversion rate. So when we have that, this is going to be the formula. The same applies to mini lots. The same applies to micro lots. Okay. So know the conversion rate. When you know the conversion rate, all that you need to do is substitution. You come, you take your values and then you put them at the appropriate places in the formula, and you are going to get a correct answer. So let's take the examples. We are not using any different examples. We are using the same examples that we have calculated for their value per pips. Okay. So we have calculated for their values per pips already. What we are going to do is that we just want to see how they are going to be affected when we add the standard lots. Okay. So for Euro GBP, as we did, when we calculated the value per pip, we had this particular value. We had this particular value, that is 0.00135 US dollar. Now, value per pip per standard lot of Euro GBP. Okay. So what you do is that you multiply your value per pip by the standard volume in unit, and you are going to get $13.5. So you can see that even this one too, 1 pip, okay, 1 pip for standard lot is even 13.5 as compared to 10 of the GBP USD that we looked at. Okay, so you can see some differences over here. It should give you an idea the kinds of pairs to trade. Okay, so when we take value per pip per mini lot, 1 pip move is going to give us 1.35. And when we take the value per pip per micro lot, 1 pip move is going to give us 0.135. 0.135. You have to take a screenshot. Take a screenshot of this, and then you revise. Okay, you revise. All right. Let's continue with the next slide. I'm rushing through it. When you get the link, then you fill in your gaps. Okay. So the next thing that we did was the Euro JPY at this particular rate. When we did the calculation, this is what we had. We had 0.000084. Okay. So for 1 pip, value per pip per standard lot, if I trade 1 standard lot and then this particular pair moves 1 pip, I'm going to get 8.84. If I'm trading mini lot, okay, the value per pip per mini lot, I'm going to have 0.884. If I'm trading the micro lot, the value per pip per micro lot, I'm going to have 0.084. It is not even up to 1 cent. It's not even up to that. So you have to take note of this. We are dealing with the cross rate. This is the cross rate that we are dealing with. All right, let's take the next example. The next example that we did, the next example was the CAD CHF. So the CAD CHF, we did calculation for CAD CHF at this particular price point, and then we had our value per pip as this. So for standard lot, that is for 1 move, if I trade 1 standard lot, my profit is going to be 10.8 for standard lot. If I'm trading the mini lot, that is 0.1, I'm going to have 1.08 as my profit if it moves 1 pip. If I'm trading micro lot, I'm going to have 0.10 as my profit if I am trading the micro lot. This is a cross rate. When we are done with this, I said I'm going to give you the good news. Okay. All right. let's take the next example. So this is the next example that I had wanted you to do. So I wanted you to find the value per pip per standard lot, mini lot, and micro lot of GBP AUD at this particular price point. But because we are pressed with time, we will take a screenshot and do it later. Okay, do it later. All right. Now, this is your assignment. So I will skip the answers that I did. I'll skip it. I didn't skip the previous ones, but with this one, I want to skip it. So I have skipped the answer. Now, what is the conclusion? The conclusion is that if you have a dollar account, the value per pip, okay, per any lot size for cross pairs, that is any pair without the USD, their value per pips are not the same. The value per pips per lot sizes are not the same. So if anybody tells you that in Forex, when you trade Forex, when you trade one standard lot, they tell you one standard lot, you are going to get $10. Then one mini lot, you are going to get $1. And then one mini, and then one micro, they tell you are going to get 0.1. Tell them that is half truth. This is half truth. That is not the entire truth. Okay, it is half truth. They are only focusing on direct rates. They are only focusing on direct rates. If you focus on direct rate, then one standard lot is going to be $10, one mini lot is going to be $1, and then one micro lot is going to be 0.1. But when you come down to indirect rate and then the cross rate, the answers are going to be different.
Questions to ask. The good news. Okay, so let's take this table. When we take this table is going to bring the light that we want to communicate. Okay, this is the table. Somebody wants the good news. I'll give the good news very, very quickly. So for instance, this is for direct rate. Okay, so if I have Euro USD at this particular exchange rate, value per pip per standard lot is 10, and the value per pip per mini lot is 1. So it means that for one pip move, okay, for one pip move, if I trade standard lot, I'm going to get $10. If I trade the mini lot, I'm going to get $1. If I trade the micro lot, this is what I'm going to get. For GBP USD at this rate, you can see it is the same throughout. For AUD USD, you can see that it is the same throughout. For NZD USD, you can see that it is the same throughout. So most of the presentation that we have cover they cover only this one. This is the only one that they cover. Okay. However, that is just one category of the pairs. Okay, that is pairs with a direct rate. So if the pair is having a direct rate, that is if your account is a US dollar account, okay, and then the pair you are having the USD as the quote currency, then for a standard lot, if you move one pip, you are going to get $10. If you move one pip in mini lot, you are going to get $1. And if you move one pip in micro lot, you are going to have 0.1. However, for indirect rate, that is where we have the USD as the base currency. With the base currency, what it means is that if I have one pip move, okay, one pip move for a standard lot, this is what I'm going to get. For a mini lot, this is what I'm going to get. And then for a micro lot, this is what I'm going to get. When you look at the USD CHF, you see that the values are not the same. The values are not the same. When you look at USD CAD, you see that this one too, the values are not the same. When you see even USD paired with the Singaporean dollar, you see that the values are not the same. So what we say is that with the indirect rates, okay, the values per lot sizes are different. You can see it over here. They are different. They are not the same. And then when you go to the cross pairs too, you are going to see that, for instance, Euro CHF for exchange rate at this level, if I trade one standard lot for one pip move, I'm going to get $10.2. Then for one pip move with mini lot, I'm going to have this, and then for micro lot, this is what I'm going to get. So this table
is going to guide you. You can take a screenshot of the table and probably refer to it in future. Thank you very, very much. Okay. All right. What again do I need to teach now? The good news. So, why are you in a hurry for the good news? Okay. Thank you, Bills. Thank you for the compliment. Okay. So, the next thing we are going to look at is how to calculate for profits or losses. With the knowledge we have had already, this is not going to be very difficult. So we will do that in 10 minutes. Now, the good news is that all the calculation we are doing over here, you are not going to do them when you are trading. It is an algorithm. So all the calculations are going to be done for you the moment you open a trade. That is the good news. So those who were confused, I want you to sigh. Take a breath in and breathe out. Okay, that is the good news. Surprise. How much does one need to join your scalping? Hey, Julius is saying hallelujah. Okay, to join the scalping, you need to deposit not less than $1,000 in your Gildes account. Now, I would, at the end of the presentation or at the end of the class, you will know all the offers that we have, okay? You know all the offers that we have. I have promised myself to give a lot of free education from this time up to June. And then from June, what I'll be doing is that I will try to focus on aspects of the academy. I'll give the free content aspect to some of the people that I am grooming. They will take over the free content, and then I'll also look at the other side that can also help us build a community. What again? Julius, you are massphobia, right? You are massphobia. Don't worry. So the calculations will be done for you. You don't need to do all these calculations. But what you need to do is that you have to know. You have to know even before you start trading. Even before you start trading. Hey, this man is a man of God. Are you a prophet? Okay. Hey, who is writing friend for me? Somebody should try as much as possible and translate it for me. Jacob, make steady, okay? Please write English. I beg you. I don't understand French. I don't read French. Write English for me. Okay, so let's go straight into how we can calculate profit. Okay. Now, there are three different ways that we calculate profit. There are three different ways that we calculate profit. Okay, and the first method is by using the value per pip per lot size. Value per pip per lot size. Okay, value per pip per lot size. And then the second one is by using point value, pip value, and contract size. So either you use the point value and contract size or the pip value and contract size. And then the last one is by using change in price levels. Change in price levels and contract size. I am saying this again. All the information I'm giving to you, they are general rules in the financial market. Okay, so the formulas that we are using over here, they can apply anywhere. They can apply anywhere. I have done a lot of research into that. So you can take my word for that. Okay. So let's go into calculation of profit. When we are using the value per pip per lot size, what will be the formula? So this is calculating profits or losses by using value per pip per lot sizes. Okay, so this is the formula. This is the formula.
Now, you are not going to worry yourself getting this, okay? Getting this because of what we have done already. When you look at this very well, you will see that the general formula is going to be profit. Your profit or loss is going to be number of pips times your value per pip per lot. So value per pip per lot times your mini lot size divided by lot size. Confusion galore, Anna. Okay, so take a screenshot of this. This is the formula. This is a general formula. Okay, using the value per pips. So number of pips. So for instance, if I have 30 pips multiplied by value per pip per lot. So if it is a standard lot, that I am trading, the value per pip. So with the calculation, we had for GBP USD, we had 10. Okay, then times volume in lot. So the volume in lot is the volume you are trading. So maybe if I'm trading 0.2, okay, then I will divide it by the lot size. The lot size I'm doing here is I'm using the standard lot, so I'll divide it by 1, and I'm going to get my profit. I'm going to get my profit. Okay. So let's go into it. You get it. Don't worry at all. You are going to get it. I will emphasize that you are not going to do all these calculations before you be able to trade, but you need to know this information as a professional forex trader. Okay.